I'm staring at 3 screens right now, and not a single one agrees with the other 2. One screen says silver is climbing, the next says silver is falling, and the third one is sitting there quietly, documenting metal walking out the back door of a COMEX-approved warehouse, while the first 2 screens argue about direction. Something cracked this morning. Not in the price, not in the headline, not in anyone's Twitter thread, in the plumbing underneath the price, in the part of the system that decides what counts as deliverable and what's just taking up space in a vault. And by the time most people notice that crack, the easy trades will already be gone and the repositioning will already be finished. Welcome back to OG John AG 2.0, where we don't recycle someone else's take and slap a new thumbnail on it. We crack open the actual reports, the actual timestamps, the actual vault-level receipts, and we let the numbers fight each other until the truth falls out. If that kind of raw, real-time breakdown is what you've been looking for, subscribe and lock in with a community that reads the data while it's still breathing, not after the story gets sanitized into something comfortable. Because what I'm about to walk you through is not a simple silver up or silver down narrative. It's a story about 3 different versions of silver existing in the same minute, and only one of them carries the legal weight to settle a contract. Let me set the stage with what hit my screens within 120 seconds of each other this morning, because the timestamps matter more than most people realize. Silver spot prints, $84.0147 at 9:28 a.m. EDT. Green, up 0.3522, a move of 0.42%. In the next tab over, gold is running harder and faster. 5,013.19 talents at 9:26 a.m. EDT, up 34.30, a gain of 0.68%, with the session already stretching between a low of 5,064.97 and a high that kissed 5,028.32. And here's where it starts getting uncomfortable for people who still rely on the old playbook. The dollar index, DXY, prints 100.25 at 9:27 a.m. EDT, also green, up 0.286, a gain of 0.29%. Dollar up, gold up, silver up, all at the same time. The textbook says that shouldn't happen cleanly. The textbook says a rising dollar creates gravitational drag on anything priced in greenbacks, especially metals. But this morning the textbook is wrong, or more accurately, the textbook is describing a world that no longer fully exists. Something underneath these metals is providing lift that the dollar's strength can't cancel out, and that something is worth understanding before we touch a single warehouse number. But the dollar metals contradiction isn't even the part that made me stop and pull up a 4th tab. This is, at 9:28 a.m. EDT, the exact same timestamp that Silver Spot is printing green, iShares Silver Trust, SLV, the most widely held paper silver vehicle on the planet, prints 7616, red, down 0.32, a loss of 0.42%, volume already humming at 2,769,643 shares traded. Spot silver says up, the flagship paper proxy says down. Same metal. Same minute. Opposite signals, that's not market noise, that's a live diagnostic, and I want you to hold the discomfort of it without resolving it yet, because we're about to go deeper into why that divergence is mechanical, not random. Peel back one more layer, and the picture fractures further. COMEX Silver Futures, front month, SI1, the paper benchmark that the entire industry uses to anchor real price discovery, last snapshot at 8:11 a.m. EDT shows 83.775, down 0.895, a decline of 1.06% on the day. Settlement from March 12th was 84,670. The day range has already printed as wide as $81.9995 to $83,815 off an open of $82,000. So now the full picture, captured within minutes of each other. Spot is green, futures are red, and the ETF is red. 3 instruments that are supposed to track the same underlying metal, 3 different verdicts on the same morning. That's not one market behaving efficiently. That's a market fracturing into layers, with each layer responding to a completely different set of pressures. Spot reacting to physical demand, futures reacting to paper positioning and margin mechanics, the ETF reacting to whoever is smashing the sell button on the most liquid wrapper available. If you believe those 3 always converge quickly and cleanly, today is your invitation to reconsider. So why is this happening? The tempting answer is noise, different data feeds, different delays, who cares? But in metals, who cares is the exact attitude that costs people money, because in commodities, basis and tracking are not footnotes. They are the trade. When spot, futures, and the ETF all agree, you've got a market in equilibrium. When they disagree, when they're flashing different colors at the same timestamp, You've got a market under stress that hasn't found its resolution yet. And the resolution, when it comes, almost never splits the difference politely. It tends to snap in one direction hard, and the people who were watching the divergence early get positioned while the people who dismissed it as noise get surprised. The divergence between these layers is telling you something specific. The market is not moving as one synchronized body. It's moving like a system under tension, where one layer can be bid while another is being sold, and both can be perfectly rational. If the constraint driving the action isn't price, but form, location, and deliverability. And in about 2 minutes, I'm going to show you a single warehouse report that explains why deliverability is the word that should be keeping every serious silver watcher up at night. And that word, deliverability, brings us to the single most important document in the silver world that almost nobody reads with the attention it deserves. The CME Metal Depository Statistics Report, dated March 12, 2026, covering activity from March 11th. This is the Warehouse Bible. The report that doesn't care about your sentiment, doesn't care about your chart patterns, doesn't care whether you're bullish or bearish. It simply records what metal is, where, what category it sits in, and what moved in the last activity day. The headline number, the one that gets quoted by people who want to sound informed at a cocktail party, is 324,923.998 troy ounces of silver sitting across all COMEX-approved vaults combined. Sounds enormous. It is enormous. Until you learn that this mountain has two very different zones, and only one of them carries the legal authority to settle a futures contract without anyone picking up a phone. Zone 1, registered, 78,610, 868.929 troy ounces. This is the metal that holds a warrant. This is the supply that can be delivered against a paper promise under standard CME rules. No reclassification needed. No negotiation required. It is the checking account of the silver market. Liquid, committed, ready to move. Zone 2, eligible. 265,730,1955.69 troy ounces. This metal meets every purity and weight specification. It lives in an approved vault, but it carries no warrant. It is stored, not committed. Think of it as home equity. Real, valuable, but you cannot hand it to someone across a counter tomorrow morning to settle a debt without converting it first. That distinction sounds academic until you realize what it means in practice. When someone tells you there are over 344 million ounces of silver in the system, they're technically correct. But when someone asks how much silver is actually available to settle a futures contract right now, under the rules of the venue, the answer collapses to under 79 million ounces. That is a ratio worth sitting with. Less than 23% of the total pile is actually deliverable. The rest is just there. Present but not promised. Stored but not sworn. And the tension between present and promised is where every interesting thing in the silver market happens. It's the gap where narratives get built and where narratives get destroyed. Now think about what that ratio means the next time you hear someone casually say, there's plenty of silver. Plenty of silver where? In what category? Under whose warrant? Available to whom? Under what terms? Those questions never get asked when the market is calm. They get asked all at once when a delivery month arrives and the contracts start demanding metal, not promises. And the answer to every single one of those questions starts in the report I'm holding right now. Now here's where today's report gets genuinely fascinating, and I need you to follow the flow closely because it reveals something that a spot price alone will never show you. In the latest activity day, registered silver received 258,738.85 ounces with 0 ounces withdrawn, producing a net gain of 258,738.85. That's the deliverable bucket getting bigger. At the same time, eligible silver received 598,969.33 ounces, but saw 1,074,686.052 ounces walk out the door, producing a net loss of 475,716.722 ounces. That's the stored bucket bleeding. And when you combine the two, the total COMEX silver pile shrank by 216,977.72 ounces on the day. Read that sequence again if you need to. The category that can settle contracts grew. The category that's just sitting there shrank by nearly double that growth. And the overall system lost metal on net. That is a market reinforcing the walls of the room that matters most, while the broader house quietly loses inventory through the side exits. I want to park a question here, and I want it to sit with you uncomfortably for the next few paragraphs. Who benefits when the deliverable number rises at the same time the total shrinks? Who is served by the optics of a growing registered pile when the combined stockpile is draining? Don't answer fast. Because this is precisely how stress gets managed in commodity markets without anyone touching the spot price. You don't move the quote, you move the category. Let me take you inside the vaults themselves, because the names and flows on this report turn abstract warehouse math into something concrete and traceable. And this is the part where, if you're watching this live, I'd challenge you to pull up the CME depository report yourself and follow along. Because what I'm about to read you is not interpretation, it's line items. StoneX Precious Metals received 258,638, 85 ounces directly registered. That accounts for the entire registered inflow for the day, the full increase, concentrated in a single depository. Not spread across 6 vaults, not trickling in from multiple sources. One house, one deposit, the entire registered gain. CNT Depository pulled in 598,969.33 ounces on the eligible side, expanding their eligible inventory from roughly 8.7 million to over 9.29 million ounces, with a new facility total of 21,000 on 80,890.849. That's the intake side, metal coming in. Now look at the outflow side because it tells a sharper story. Manfra, Tordella, and Brooks saw 1,058,679.682 ounces of eligible silver walk out in a single activity session, over 1 million ounces exiting one vault in one day. Let that scale register. 1 million ounces is not a rounding error. 1 million ounces is a decision. On top of that, an adjustment of 4,667,506 ounces shifted from eligible to registered on their books, mirrored by a negative adjustment of the same amount on the eligible side, which tells you the classification machinery is part of the daily accounting, even when the big flows are happening elsewhere. An HSBC bank recorded another 16,006.37 ounces of eligible withdrawn. Smaller in scale, but part of the same directional pattern, eligible leaving the system. These are not anonymous flows from unnamed sources. These are named depositories with documented movements on a CME report that anyone with an internet connection can pull up and verify right now while this video is playing. And the pattern they paint is consistent. Metal entering on one side, metal leaving on the other, and the deliverable category being reinforced in the middle. So what does any of this mean if you've never touched a silver bar and never plan to deliver one against a contract? More than you think. It means the number on your screen, the spot price, the ETF price, the futures price, can sit perfectly still while the infrastructure underneath is being actively rearranged. It means stress in metals almost never announces itself with a dramatic price spike first. That's the Hollywood version of a squeeze. The real version is quieter and far more dangerous. The real version starts with divergence. Spot and the ETF pulling in different directions one morning, futures and spot disagreeing on the day's tone, warehouse categories shifting beneath the surface while the headline inventory shrinks by a couple 100,000 ounces that nobody notices. And by the time those layers snap back into agreement and the trend becomes obvious to everyone scrolling their feed, the repositioning underneath is already finished, and the opportunity has already been captured by the handful of people who are watching the plumbing, not the paint. Every major dislocation in commodity markets over the last 2 decades followed this exact playbook. Not a sudden event, but a slow divergence that widened until it couldn't anymore, then corrected violently. The question is never whether divergences resolve. The question is which direction they resolve in, and who's already positioned when they do. Now I owe you the bearish case, and I'm going to deliver it with the full weight and respect it deserves, because if this channel only fed you the bullish side of every data set, it would be a fan club, not an analysis desk. Here's what the bears see when they look at the exact same data, and they are not wrong to see it. First, registered silver is not collapsing. It just expanded by over 258,000 ounces, which means the deliverable category is growing, not shrinking. If the market were truly in a physical squeeze, you'd expect registered to be draining, and it isn't. Second, the combined stockpile remains above 344 million ounces, with over 265 million still sitting ineligible, which is not a number that screams crisis by any honest reading. Third, SLV is down 0.42% on the session with nearly 2.8 million shares already traded, indicating active selling pressure in the very wrapper that millions of retail participants treat as their silver exposure. Fourth, front-month futures are red by over a full percentage point at $83,775, meaning the paper layer that anchors institutional price discovery is not confirming a clean bullish impulse. Fifth, the dollar is firming at 100.025, and historically, persistent dollar strength creates a drag on every commodity priced in greenbacks. The bearish thesis is straightforward and intellectually honest. Deliverability is expanding, paper instruments are not confirming spot's green print, and the macro backdrop offers no obvious catalyst for a breakout. That combination can keep silver range-bound, choppy, and deeply punishing for anyone married to a single direction. That's the bearish case. I respect it. I've laid it out as strongly as the data allows because you deserve to see both sides before you make a single decision. Now let me show you what it has to deliberately look past to stay intact, because the same data that builds the bear's argument also contains the cracks in it. Spot silver is green, while both the ETF and futures are red. That is not bearish confirmation. That is a fracture between the physical layer and the paper layer, and fractures do not heal by being ignored. Gold is running 0.68% higher at $5,113.19, while the dollar is also green, which means the monetary bid underneath precious metals is overpowering dollar gravity in real time. That dynamic does not show up in ordinary market conditions. The combined warehouse total shrank by 216,977.872 ounces on the activity day, meaning metal is leaving the system on net, regardless of what the registered number does inside the system. And that registered increase didn't come from some organic flood of new metal rushing into the delivery pipeline. It came through targeted inflows at a single depository and small reclassification adjustments, which looks less like abundant supply and more like a system concentrating its deliverable resources exactly where they're needed for settlement optics. The bullish case is not price go up tomorrow. The bullish case is the structure is in motion, and structure in motion is where dislocations begin. Quietly at first, then suddenly. Now let me circle back and resolve the SLV contradiction mechanically, because it deserves a structural explanation, not an opinion. SLV at 76.16, red 9:28 a.m. EDT, spot at $84.147, green 9:28 a.m. EDT. Here's the resolution. The ETF is a vehicle, a wrapper, a traded product with its own order book, its own authorized participants, its own creation and redemption dynamics that operate on a different rhythm than the spot market. When participants want out of silver exposure quickly, they don't phone a vault in Delaware. They sell the most liquid thing with silver in the name. That selling pressure can push the wrapper red even while the underlying metal is being bid higher through a completely different set of transactions. Neither price is fake, but one is the metal itself, and the other is a financial product built around the idea of the metal. And products can skid sideways even when the road underneath them is climbing. The same mechanical lens applies to the warehouse shuffle. Registered up. Eligible down by nearly double. Total down. Adjustment lines quietly shifting small amounts between categories at Manfra. The system isn't broken. The system is actively managing its most critical resource, the perception of deliverability. And active management is what you observe when someone, somewhere, needs the registered number to hold or grow, even if the total pile cannot. Here's the macro frame to close the loop, because no metal trades in a vacuum and no divergence exists without a broader context pressing on it. Dollar at 100.025, gold at $5,113.19, stretching from a low of $5,064.97 to a high of $5,128.32 in a single session. Silver spot at 84.1147, all three green simultaneously. That trio delivers a specific message to anyone listening with the right framework. Hard asset demand is absorbing dollar strength this morning, not buckling under it. The old inverse correlation, the one that says a strong dollar pushes metals down, isn't gone. But it's being overwhelmed by something bigger. Whether that bigger force is sovereign reallocation, institutional hedging, or simply the market sniffing out a monetary policy shift before the press conference confirms it, the effect is the same. The metals are bidding through resistance that should be holding them down. And when that dynamic takes hold, silver becomes the most volatile battleground in the precious complex, because it carries a permanent identity crisis, half monetary metal, half industrial commodity. And the paper instruments trading around it become the public stage where that identity crisis gets priced in real time. Gold gets to be one thing, silver has to be everything. And that's what makes its divergences louder. It squeezes sharper, and its warehouse data more critical to understand than any other metal in the system. That's why the number from the very first second of this video, 78,868.929 registered ounces, carries more weight than every hot take published today combined. It is not a statistic to skim past. It is a boundary line, the hard, bright border between metal that can fulfill a promise and metal that is simply occupying space on a shelf. When markets are calm, that border is invisible and nobody thinks about it. When markets fracture, when spot prints green while the ETF prints red, while futures print red, while the warehouses are quietly reshuffling what qualifies as deliverable in the background, that border becomes the single most consequential variable in the entire silver market, and almost nobody is watching it closely enough. So here is the hypothesis I want to lay on the table. Not as a prediction, because predictions are for people who confuse conviction with accuracy, but as a structural projection you can test with your own eyes over the coming sessions. If registration continues to rise while total inventory continues to fall, the system is funneling deliverability into a tighter and tighter corridor. That is manageable. right up until it isn't. And the moment it stops being manageable, the first warning won't be spot silver printing some dramatic round number. It'll be the gap between the spot and every paper wrapper built around it getting wider, not narrower. Track that gap. Measure it daily. Because today's screens just handed you a live, documented preview of what that widening looks like in its earliest, quietest, most ignorable stage. If this breakdown gave you something the surface-level recap never could, send it to one person who still believes that clicking buy on SLV is the same experience as owning Deliverable metal. They need this walkthrough more than they realize. Hit like so the algorithm pushes this past the noise machines, and subscribe if you want to be in the room when the next divergence prints live, not 72 hours later in someone else's polished summary. And if you held through every word, drop OG John AG 2.0 in the comments like a receipt, your personal timestamp proving you don't just glance at prices, you interrogate the machinery behind them. The philosophy never shifts, only the phrasing. Logic over hype, evidence over emotion, always. The screens split apart this morning. The real question is whether they snap back together or keep pulling wider. Structure reveals. Slogans conceal.